Welcome back to Global Money Talk, live from the New York Stock Exchange. For today's second half hour of the show, I'm joined by Sang Lee, the founder of SPC Investments, and he will talk about selecting great investment managers. Before founding SPC Investments, Sang spent 18 years at GIC, the Singaporean sovereign wealth fund, where he spent a number of years as the head of equities, external manager selection, and also helped positions in research as well as portfolio management. So, thank you so much for joining me and welcome to the New York Stock Exchange.
Thank you so much for having me here.
Well, for our viewers, can you tell us a little bit about your long and storied career?
Sure. Yeah, I just finished 25 years of working. It's been an amazing journey. The last 18 years of which at GIC, which is the Singapore sovereign wealth fund. So I joined GIC in 2006 out of business school. My first job there was a equities department where I researched industrials and healthcare stocks and ran a sector portfolio. And then our team was subsumed into a larger group, so I continued to pick stocks for about 7 years. And then thereafter, I worked in external fund management as an allocator. So there I headed an equities team. We had a global presence, and I cover long, short, and long-only managers. It was a great experience. Did it for about 5 years. And then in the last 6 years, or the final 6 years, I was able to get a position back in research. Came back and did strategic themes and long-term research. Spend most of my time on commodities and commodity equities.
Well, speaking of 25 years, that's a quarter of a century. So you've been through many market cycles as well as many different policy cycles. So I'm sure you can offer your experience to a lot of clients out there and for viewers who might be curious to know more. But what is next for you?
Yeah, so as I mentioned, I finished the first 25 years working. I'm now preparing for the next 25 years. And then in particular, I want to build a stock investment portfolio comprised of sort of the best / hidden gems from select equity managers, as well as the proverbial 10 baggers from my own research. So still in the R&D phase of it, but I think I'm getting there. And it's the first time doing something of my own, so it's exciting, but of course a lot of uncertainties.
Well, I think the market by itself is uncertain to begin with. So can you tell our viewers out there who might not be familiar with terms like hidden gems or 10 baggers, what does that actually mean?
Yeah. So market has a way of coming back, and when an investment manager figures out a particular stock, it's hidden. But then for various reasons, whether it's earnings, valuation, or whatnot, it could be out of favor or it could be undiscovered. But the market has a way of finding these gems and so forth. So those are things that I want to do. At the same time, the market is a short-term mechanism. So they look at the near term, the next quarter, next 2 quarters, and sometimes omit to think about the longer-term impact. So to the extent that one can extend the time horizon and look at some of these things on a longer-term basis, and then get in early with the timing arbitrage that you have over a long period of time, you could compound your capital quite a bit.
And what about 10 bags?
Yes. Yeah, and then so 10 burgers are interesting. I mean, you think that, oh wow, we just missed AI. No, but that's not true. In any market conditions, whether in the 2000s or 90s and so forth, there were 10 baggers over 3 to 5 year period. I thought about this a little bit and did some exercise. So, for example, there are companies that go from negative earnings to positive. There are companies that are quasi-interesting and became sort of a dominant mode. These are all companies for which these notion of 10 baggers actually apply. And well, also the fact of the matter is, a lot of these 10 baggers, they go straight and then they actually go down 80% before going up 10 bagger, or they do nothing for 8.5 years, and then in the last year and a half it goes up. So there is a need for understanding the dynamics of how things play out, whether in business or sort of the market structure. And with the timing arbitrage that we have, I think that's something that we can try to make it happen.
And since you've been in this business, in this space for 25 years, I'm sure you can walk us through examples, because I can think of several names that might fit into this category, whether we're talking about potential hidden gems or 10-baggers. But can you walk us through any companies that come to mind?
Yeah, so, for example, definitely NVIDIA, definitely Amazon. These are all companies that became 10-baggers, or even look at Microsoft or Adobe. The way I think about these companies are, well, they started as a product or two, but then because they became part of a bigger driver for the consumer, it's one where absolutely needed. For example, Apple. So in the first instance, when Apple first came out, a lot of people had issues about them just being a consumer products company. But later on, it became a sort of a consumable, where you have the network power as well as the definite hold in the consumer's wallet. So as Apple came out with new products and kept upgrading, and then people came on and bought more. So it became a huge, humongous earnings story, and has become a 10-bagger.
Okay, well, I do want to move on to talking about selecting stocks versus managers. So give us some insight here.
Yeah. Well, just a quick caveat is that in the institutional space, you have a lot more information to digest as well as to analyze. But I think the principles are equally applicable, so I wanted to share that. I've actually prepared a few slides, so maybe we can go through and take a look real quick. Yeah, so here I just wanted to kind of lay out sort of the three most important things between stocks and fund managers. So on the stock, so these are the three things that I feel are the most important: business, management, and valuation. So starting with the business, what kind of business is it? What do they do? What kind of pricing power do they have? What's the margin structure? What kind of financing is required? Is the financial position sturdy? What about return on assets, return on equity, incremental ROIC? These are all questions that we all ask, when we look at these companies. And what about the positioning within the industry versus the competitors? So this is the first important factor. The second important factor is management, of course. Who runs a business? I mean, even if it's a great business, if it's not run by great management, then you could have mistakes, or you could lose market share, relatively speaking. How aligned is the management versus the everything that's out there? So the most critical analysis or the factor in determining management is actually capital allocation, how they use the funds to do so. And finally, on the valuation, yes, because we're in the business of investing, where we define as putting more money in the hopes of making more, we need to think about entry and exit. So here, we could think about intrinsic value metrics such as DCF, but also common yardsticks, multiples and yields, and so forth. Now, one interesting thing that I want to point out is the notion of what is priced in. So often, we read the newspaper and say, oh wow, this is interesting. But by the time, it's already priced in. So if the piece of information that we have, or the research that we have, is already priced in, or is already reflected in the market, then the upside potential is that much less. So I think that's something that we have to understand when it comes to valuation. Okay, and then now moving over to the right-hand side and looking at the funds. Okay, so these are the three things that I would like to focus on when it comes to fund managers. The first is investments themselves. Obviously, we're allocating to managers who are supposed to be stewards of our capital. So we have to understand how they do it, how they are able to generate profitable investment. Okay, what do they do with it, how they make it happen, what do they do with it when they find it, and then what do they manage and so forth. So that's number one. Now, factor number two will be portfolio management. It's basically a broad term for basically running the portfolio. Questions like, how do you think about position sizing? How do you think about entering and exiting the investment? What do you use? IRR, some sort of a multiples, price target. They're all different kinds of things. In addition, we have to think about, okay, what kind of guardrails do we have in terms of risk management? What happens when losses occur in a drawdown? So it's not just having a good set of investments for the manager that they have, but also the running of it that is actually critical. And then finally, number 3 is the overall setup. So, here we're basically looking for repeatable process and a sustaining operation. So when we allocate to managers, we're underwriting their process and making sure that they are able to generate and repeat this over and over. So we're looking at how they can do it and then whether the process is repeatable and whether they're set up not only in the investment side of it, but also the business of it. The HR, front office, mid office, back office, all of that combined is whether they have a sustaining setup as well as the good alignment of interests with the partners, with the investors, with the employees and so forth.
Well, there are a lot of moving parts there that you just mentioned, but one thing that stood out to me is what you said about information. So all of us have access to so much information when it comes to companies, but then there's something called the financial news media where investors out there, retail investors, might get some information. So one thing I want to ask you is, when you say something is priced in and access to information, so depending on which side of the business you're in or on, then you might have access to different reports or information that the retail investor may not. So how do you know what to focus on?
No, it's a great question. I think fundamentally, and that's the reason why the investment is one of social media, social science, where we have to go out and figure out what other people are thinking.
Yeah.
So to complete the research, we have to talk to people to understand what of the information is priced into market. Classic investment philosophy, there are 3 parts to the market. You have the sell side that sets the market and that has their own way of looking at things. You have the buy side that actually does the risk taking, so you have to understand what they're thinking and what their theses are. And then you have the companies who understand the industry and their results themselves. So part of it is triangulating what each of these different parties have and understand. And for retail investors, such as our audiences, including ourselves, we just got to read. There's no better way of doing it other than reading, whether it's transcript, understanding the company's positioning. We also have to understand what other people are doing in the industry and so forth.
Yeah, I think that's very key here, because when we think about publicly traded companies, names that are listed here on the New York Stock Exchange and are traded, that means the public has access to public reports, correct? Whether we're talking about quarterly or annual, any management changes that might happen to a company. So let's talk about stocks first. Tell me what you think is important when it comes to stocks.
Yeah, so as mentioned, okay, maybe I can share a bit about my own research process. It's pretty simple. So I think about it, okay, first we're going to do the research and try to figure out, what is the piece of information or understanding that I have about the company that is not available to the market or unique, whether it's a longer-term timing arbitrage or analytical or information. Okay, and then the second step that I go through is understanding, okay, how much of this is priced into the market to get an understanding of it. And then the third part would be, okay, well, companies, scenarios, market environments all have different ways of happening. So what are the scenarios and what are the probabilities that I would assign to these different things? The fourth step would be, okay, well, it's nice to have all these scenarios and so forth. What are you going to do about it? So what is the initial positioning of it? Whether you're going to go in with a 1% position or 5% or whatnot. And then finally, how do you set the roadmap to say, okay, well, if these things were to happen, the company's tracking on okay, and then we're going to do it. If not, then then we exit and move on. So it's an integrated process and it's an iterative process of looking at the information, checking back to see what is already priced in, and going back and forth and back and forth.
And I'm very curious about your second point in terms of what is priced in. Can you walk me through how you actually go about doing that?
Yeah, so again, as I mentioned, reading is a critical part. So, for example, we read on the newspaper that so and so, some famed investor is doing this or doing that. Well, by the time they're coming into the market or that news is being reported, it's almost like saying that the trade has been made and maybe it's now in the momentum phase, or maybe it's being sold down. And that's the reason why that a lot of people read it after the fact.
Sure.
Right? So it's that understanding of, so it's not about the margin potentials or the valuation, but rather understanding the asymmetry of the information that we have or the research that we have to say, okay, well, is this priced in or is this not priced in? So in the example, a recent example would be AI. When AI was, going gangbuster, people started thinking, and the smarter people or the folks who research early started looking at the data centers, the electricity, to say, oh my gosh, we have so much demand for AI. Where are we going to have all this electricity? So some of these utilities companies start running up. So that would be another good example of the asymmetry that I'm talking about.
Yeah, but you do need to be able to extrapolate that information and that data out there, because the thing is, having information is helpful, but when there's a wealth of information, right, on the heels of an earnings call, to sift through a transcript and to be able to understand where are the correlations, where are the relationships, and how do you actually find that asymmetry, that can be very difficult. So I do want to ask about experts when it comes to this field, and what matters when it comes to fund managers.
Yeah. Well, maybe I can show you by way of looking at the process of selecting a fund manager. So maybe we can look at the second slide that I have prepared. Yeah, so this is a typical due diligence, which I call it an articulation process. So first of all, I think you start with the fund description. I think some of the lightings are not there. Yeah. But we want to first understand the strategy. Then we want to understand what the manager does. It's our first step in allocating funds. We try to obtain a clear view of what the manager does, the objective. What's the goal? What's the benchmark? How they're going to do it? What happens in a down year? What happens in a down month? What do they do? And triangulate all that. And in addition to that, we have to also think about the team. Who makes this happen? Who does what inside the team? How are the decisions made? And what is the process of getting the ideas onto the portfolio? Which moves on to the next box, which is the portfolio itself. And here we have to think about the content, and we have to think about the structure. What I mean by content is simply the investments. So how are the investments there? What are some of the major dominant themes? How long do they have they had it? All the usual diligence questions that we've had, and so forth. And then the overall structure. So it's sort of a slicing and dicing of it to say that, okay, well, what are some major themes embedded? What are some biases? For example, is it, what's the exposure into Magnificent Seven, a particular sector or theme, and so forth. And then third, we then move into the evaluate the risk management. And here we look at the parameters, and then we look at the drawdown. So parameters such as, okay, what's the maximum position sizing, or individual position level, the top 5, top 10. There are some parameters that the fund will say that they will do, and then that they will follow. So you have to evaluate that. But more importantly, we have to look at the drawdowns. So drawdown being when things go down or things go bad, how bad, and what are the actions taken in that place. So due diligence of a fund is much more like a Columbo, a detective Columbo's work, where you just kind of get a piece of paper and ask questions, and then come around, triangulate from different angles, ask the same thing, and then at the end ask, okay, what's the next example, and so forth. And then finally, after doing all this, then you have to form a thesis, right? So to say that, okay, what are the expectations? What are the roadmaps? So here's how stocks and bonds versus investment managers differ, in my view. So with companies, you have cash flow. So you could say, okay, I'm going to get in, I'm going to get out, right? But with investment managers, there's no such thing as cash flow. So, we have a conversation, we do all the reports, go through our investment committee process and say, okay, this sounds good. But then we have to say, okay, what is an expectation of the manager? What is their expected return, expected volatility? What type of drawdowns they're going to have in order to achieve the alpha that they're supposed to generate? Yeah. As well as the fact that we have to establish roadmap to say, okay, well, managers could deviate from style, or it could go down depending on the market structure. So how are they going to guardrail? And to the extent that adverse events happen, what is the roadmap from the allocator perspective? And do we redeem? What kind of conversation we're going to have? It's a very iterative process. Yeah. So in this sort of setup, by laying out the due diligence, I thought I'd just kind of highlight some of the important things when it comes to finding fund managers.
Yes, and I think it was very helpful for viewers to actually bring that graphic up to see this due diligence process and for you to walk through the individual steps and give us an overview of this. But I do want to move on to the manager. So tell us a little bit about the due diligence process of selecting fund managers in terms of strategy first.
Yeah. So that depends also on the market. Right? So I'll give you an example. For example, there are certain strategies that are out there that require a particular environment. For example, let's say you're an activist manager, right? So an activist manager does a lot of things, talking to the management, using the media, proxy fights, all kinds of stuff. But a lot of the tools that they would employ require a market that's actually going up. Yeah. So that would be one. Let's say that the judgment of the allocator said, oh wow, this is going to be a very volatile market. Then maybe you want somebody who can understand patterns to say, maybe a CTA manager or somebody with a lot more momentum or pattern recognition. So these are some of the things that are nuances that we would find in selecting managers to say, okay, well, what kind of environment that we're in and what would be the best fit for the environment to that. And then, of course, from there, then we go into due diligence.
And I do want to move on to something that you mentioned when it comes to portfolio as well as risk management. So can you give us a deeper dive when it comes to these 2 points?
Yeah. Well, there's no, again, its caveat is that the institutional setting is much more information. So, you would gather data from the manager and then start dissecting, alpha versus beta, sector exposure, sector risk, and then there are all these diagnostics that you can run towards try to figure out the factors and so forth to understand the portfolio. Then, of course, talking with the managers to say, okay, what is it they own, what are the common themes, and then, as I mentioned, the common diligence of going by, figuring out individual names to say, okay, this is what happened, and then kind of building a holistic picture. And then you will also talk to the team members besides the portfolio manager to say, okay, well, how does who does what and all that jazz.
And moving on to thesis. So this is something that you went into, but can you provide a deeper look into what exactly goes into this?
So, believe it or not, my own view of manager selection is much more like a fixed income analysis, where rather than equities analysis. So in equities, we say, okay, well, what are the conditions today, and then what good things could transpire in the future. Whereas in fixed income, the highest you can get is 100, right? Now, with the manager selection, the way I think of it is, well, we want to make sure that they get to repeat the investment process in a good, sustainable setup over and over and over again. So to me, in that sense, manager selection is a little bit like a fixed income analysis rather than an equities analysis. Now, going back to the thesis, yes, then you're trying to identify what are the specific things. For example, it's a great portfolio manager with a track record. It's a firm that has a lot of reach and network to be able to triangulate different ideas that they have. It's a great risk management setup where, for example, the multi-manager platforms would have different risk parameters that they have to work with. So we're looking for things that are unique to them, that we believe can be the engine for generating that alpha going forward. And then, of course, as I mentioned, you have to think about the risk, and then you also have to establish the roadmap.
So you mentioned all these moving parts, and there are a lot of moving parts, and we know that this is very time-intensive, knowledge as well as labor-intensive. So when you think back to your years of experience, can you walk us through an example of a successful event that comes to mind?
Yeah. So, we think about the market cycles. So as I mentioned, okay, you have to first think about the overarching environment. The overarching environment is one where the market is recovering after the attack, after the financial crisis. Then you would allocate funds going into that. After the election outcomes change, then you could say, well, there are different of these dynamics that favor a certain part of the sector. So it could be allocated to the sector managers. Most of the successes that I've had, or that that our teams have had, is in tech. When the new technology, sort of the notion of S-curve, and when things are changing, being able to find managers who can identify these trends and then upsize and make it happen in a big way. So getting into those managers have been profitable in the past.
And can you name exact years or any company names when you're talking about some of these cycles that you've been through?
Actually, so after 2016 was one period. I hesitate to name actual names.
Okay, so you mentioned AI, and in recent weeks and recent months, we've been seeing this unwinding of some of the trade, the long Mag 7 trade. But you mentioned AI, and when we take a step back, and we all know, of course, hindsight is 2020. So when we think about the advent of the internet and how that changed when it comes to technology, where do you think we might potentially be when it comes to artificial intelligence? Are we still in the early days, or yet to see?
Yeah, I think it's still early days. I think the way I think about it is, well, you got to first invest the money in the infrastructure, and then we have to have the applications. So in the first phase, we had all the big tech companies buying all these equipment to start. And then now we're starting to see the applications of it, whether it's Copilot in Microsoft, and of course AI is already embedded in so many different industries. So there needs to be a consumer adoption that needs to happen further. And of course the market is saying, well, where are the applications, where are the ROI, return on investment? I think these are slowly happening, and it's gonna continue. So I mean, currently, people talk about, well, it's just for translation, or for selecting, or coming up with a travel schedule, and so forth. But I think the productivity angle will be greater, and then we'll see more and more of it as years go down.
Yeah, and I'm glad you brought up productivity, because there are still questions that are unanswered in terms of how this new technology, artificial intelligence, will be applied and how it will affect industries, and not just technology, but overall in both developed as well as developing economies as well. So we will have to wait and see. So as we edge closer to the end of today's show, I do want to take a look at the investor's checklist. So first and foremost, before we wrap up, do you have some insights to share?
Yeah. So I prepared this last slide. Let's put him up. Yeah, so this is my sort of a quick and dirty checklist. It's a mental exercise that I go through before decision making. So on the left, these are the 4 questions that I ask. First question is, well, is there money to be made? So it's an obvious question that but because we're so into the weeds and trees, we often kind of forget. But it's a fundamental question that we have to say, okay, well, is there money to be made, and why is there money to be made? Is that because of the market cycle? Is that because of a new theme or investment? So these are things that I think we have to ask. It could be a particular way of investing. It could be trading manager, as I mentioned, or CTA. But anyways, the first question that we have to ask is whether really if there's money to be made. Then I think the second question we have to ask is, what kind of money is it? Is it alpha or beta? So beta, as we know, is the market, and alpha is above and beyond the market. So, for example, in a lake, all the ducks rise together. So, in a good market, everybody who owns or who's exposed to the stock market will go up, but that's beta. But we're looking for alpha, so above and beyond. So what is the specific thing that the manager is able to do or exploit above and beyond? Is there a particular situation or way of doing it that allows them to do so? So I think that's the second question that we have to ask. And then we have to ask about the team and the setup. So the first two questions will be about the money making, whereas the last two will be about the team itself. So the third question we have to ask is, are the best years ahead of them? Often, managers come to you or come to us because they've had a great track record. In fact, we'll say, please come back to us after X number of months or X number of years. That's great. But by the time that they've come to pitch you the idea, maybe the market environment has changed, or maybe the dynamics that allow them to generate that alpha has changed. So we have to have a fresh pair of eyes and look at it and say, okay, what is it going forward for them? So in that regard, the question is, are the best years ahead of them? So we'll do that. Okay, and then finally, since manager selection is a competitive, comparable business, so we have to ask, okay, are they the best in the crowd? And then, in order to do so, we have to look at many other managers in this space to do that. Now, moving on to the quickly, sort of the three reminders that I have for myself. So, first of all, is we underwrite the process, not the outcome of the portfolio, because again, as I mentioned, it's a Detective Columbo way of looking at things and say, okay, is it going to happen again? Why is it? And so forth. And number two, in the due diligence process, we have to focus on identifying that special something. What is it that the manager is able to do over and over and over again? And then finally, of course, we have to be humble and avoid some of these common pitfalls. Reliance on short-term records, concentration, opinions versus facts, flash behaviors, and so forth. Since we mentioned AI, for example, if I am predisposed to growth managers, and in a growth environment, I may be saying, well, wow, this is great, but we have to be careful. So we have to separate what is a fact versus a opinion.
Well, it was such a pleasure having you on today. Thank you so much for sharing all of your experience, your processes, as well as insights with us today.
Thank you so much.
And before we go, we will take a very quick look at the broader market. We are seeing the Dow Jones Industrial Average, NASDAQ, and S&P 500 in the red today. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Well, thank you so much for joining us, and we'll be back tomorrow. Have a great day.